Is everyone. We are doing CFA level 1 and my name is Rishi Jain. We will be continuing with our class on financial statement analysis, and today we will be taking up LOS 23, which deals with long lived assets. But before we get on to that, if you like our videos, please like, share, subscribe and press the bell icon. Every little thing that you do helps to motivate us to put more such videos for your support and help. Now, before we move forward, let me just show you one more thing. How you can avail the MEPL classes. For that, you need to go on meplclasses.com. On the website, you can go to the courses tab and select international courses. Once you reach the page of international courses, you can select the CFA option from the categories bar. And here you can see that you are getting two options. Both are identical in terms of price. However, the first one is for access on your mobile phone. If you want to take our classes on your mobile application, then you will select the first option. And the second one deals with laptop. And in case you want to take our classes on your laptop, then you will select our second option. Also note that if you have by mistake purchased any different option, if you have purchased the mobile but you wanted the laptop option, please contact our technical team and they will be there to support you. This is it for MEPL classes and how you can avail our regular classes. Now, let us get back to the real class. Today we will be dealing with long-lived assets. I hope it's very clear from the name, but before we move forward, I want you all to think what are long-lived assets and where do they appear on the financial statements. Where do they appear on the financial statements? In the class of understanding the statement of financial position or understanding balance sheets, we learned the format. We saw the format of balance sheets, right? So where does long-lived asset appear on the balance sheet? It appears in the asset section, right? Now also under the asset section there were many subdivision, right? So under which subdivision of assets does long-lived asset will come under? It will come under non-current assets. Now under non-current assets as well, there were many different types of assets, such as there were property, plant and equipment. There were financial assets. There were loans and advances. Capital and many other things also, but for today's class, long-lived assets, the term is considering only these two things: property, plant and equipment and financial assets. These two terms come under the flag of long-lived assets. Now even under this, today's class will primarily focus on property, plant and equipment. This is the focus of our today's class. I hope everybody is clear. So let us begin. Like in every class, this first page is just going to tell you what is it that the CFA Institutes wants you to understand after completing this chapter. So these are the sections of this chapter, or the subdivisions of this chapter, and you are going to learn these things in this chapter. So let's go through them very quickly before moving on. So A, the candidate should be able to identify and contrast costs that are capitalized and the costs that are expensed. So when we are spending on non-current assets, there are certain costs which are expensed and certain other costs which are capitalized. So we need to identify and contrast the difference in those different kind of expenses. Next, we compare the financial reporting of the following types of intangible assets: purchased, internally developed and acquired in business combination. We'll learn about this later. Explain and evaluate how capitalizing versus expensing costs in the period in which they are incurred affects financial statements and ratios. So ratios have lately become the favorite thing that we all financial analysts love to think on read about. I hope as financial analysts you all have started reading annual reports of companies, and you will find that every company is reporting their financial ratios. And like we read in the financial analysis class, we also heard that every company, depending on the industry they are in, they will report certain different ratios. For example, in case of a company in retail, they might report a ratio such as revenue per square foot. So we will be learning about how do long-lived assets and the different options that we have under the accounting standards, how does adopting different standards impact the financial statements and ratios. Next, explain and evaluate. Sorry. Next, describe the different depreciation methods for property, plant, and equipment and calculate depreciation expense. We have already learned about depreciation, but today's class will be doing it in much more detail. Describe how the choice of depreciation method and assumptions concerning the useful life and residual value affect depreciation expense, financial statement, and ratios. Again, since we have different options, we will be understanding the impact of different options on financial statement and ratios. Next, describe and describe the different amortization methods for intangible assets with finite lives and calculate amortization expense. Now, amortization is the same concept as depreciation, only the difference being the term amortization is in relation with intangible assets. Next, we will be learning about describe how the choice of amortization method and assumptions concerning useful life and residual value affect amortization expense, financial statements, and ratios. This one and this one are nothing exactly the same. As a matter of fact, as far as I remember, F and H we are dealing with together. Next, we'll be learning something about the revaluation model. Then we'll go on to explain the impairment of property, plant, and equipment and intangible assets. Again, we have touched upon the topic of impairment, but in today's class, we'll be doing it in much more detail. Explain and evaluate how impairment, revaluation, and derecognition of property, plant, and equipment and intangible assets affect financial statements and ratios. This is a more comprehensive section of the chapter and will describe everything that we have dealt with and how it is impacting the ratios and financial statements. Then describe the financial statements presentation. This is just the disclosure section and we'll just be going through this very quickly. Then analyze and interpret financial statement disclosures, again disclosures, and finally we'll be learning something about investment property. So this is what the CFA institutes want you to know after completing this chapter. I hope everybody is buckled up and we are ready to move to the actual portion of the chapter. So let us begin. Okay, so first we'll be learning what are long-lived assets. Long-lived assets are assets that are expected to provide economic benefits over a future period of time. What does this mean? That if any asset is going to provide economic benefits to us, so future economic benefits must flow to the firm, is a must. This is a mandatory requirement. If there are not future economic benefits in future periods, then it cannot be called a long lived asset. Then it will be a current asset, something that will be realized within the accounting, within 1 year or within one accounting cycle, operating cycle, usually longer than a year. These assets include, again we have talked this about, tangible assets, intangible assets, and financial assets. Financial assets are those assets that are equity or debt of other companies. So for example, if I am a company and I have surplus money and I'm going to invest my surplus money in the stocks of any different company. For example, let's say I'm Meta, and as Meta I have additional cash, and that cash I'm investing in the shares and securities of some different company. That will be called as a financial asset. That is not the main concern of today's chapter. Today we'll be more concerned with these 2 points, that is intangible assets and tangible assets, right? So what are tangible assets? So any, let us say we have a building and inside the building we have furniture and we have machinery. We have many different items inside the building which we'll be using in our manufacturing process. So in this example, the building, the furniture and the machinery, all are examples of property, plant and equipment which fall under the category of tangible asset. So all these are tangible assets. Why are these tangible? Because we can physically touch them. For example, I am sitting on a chair and I can touch this chair, right? I can feel this. So this is tangible. The term tangible means we are the ability to touch. We can touch these assets. So they are fixed assets or property, plant and equipment which can actually be touched. Examples are land, building, furniture, machinery, etc. Now, any fixed asset which will be giving us future economic benefits, again, the term future economic benefits is key. If it is not giving us future economic benefits, then it cannot be called a long-lived asset. Now, if it is giving us future economic benefits for multiple periods, then it is a long-lived asset. But now, considering if we cannot touch them, so what are assets that cannot be touched? We have already discussed them in previous classes, but just for your help, patents, copyrights, trademarks, goodwill of a company, all these are examples of intangible assets. For example, I am a scientist. I am a scientist and I have invented a new product. Why will I be incentivized to share that new product with everybody else? Let us say I introduce the new product in the market and immediately people copy it and start running their own businesses of a copy of my invention. Will I be incentivized to share it with the public? That is where the government steps in and grants me a patent. They say that I will be having exclusive rights to manufacture and sell my products to the public. And that exclusive right is called a patent. So even though I cannot see a patent, there is no physical appearance of a patent except for the documents. That is not what the patent actually is. The right, it is a right. So even though there are some if papers that which signify that I have a patent, but in if we look at it in a sense that we cannot touch a patent directly, right? Except for the papers that represent the patent, they are representing the patent. They themselves are not the patent, right? So that is an example of an intangible asset. Similarly, trademarks, copyrights, these are rights which give people exclusive rights. For example, trademark is giving you exclusive rights over a name or a logo, and copyright is used for music and books. So for example, I have written a book or I have produced a movie, then I'll be required to get a copyright so that other people cannot benefit from my invention. I hope everybody understands the meaning of long-lived assets and what is covered under the definition. In today's class, we'll be more focused on intangible assets and tangible assets, that is property, plant and equipment section. Now, generally any cost associated with long-lived assets are capitalized. So for example, if I have purchased a machinery and I have paid transportation to bring the machinery from the seller till the floor of my factory, both of these expenses will together be capitalized under the name machinery and will be kept under the head property, plant and equipment. And after I have capitalized the cost that has been capitalized is allocated over the useful life of the asset under the name of depreciation. So they are included in expenses under the income statement under the guise of depreciation. That is how we allocate the cost of various property, plant and equipment. I hope everybody is getting what I am trying to say. So now that we have understood, there's one more concept that we will understand and then we'll take on an example. So the concept is called capitalized interest. So let us say that I am going to construct a machine, construct a building, let's say. So now the building is going to cost, let's say $1 million. And to construct the building worth $1 million, I take a loan of $500,000. When I borrow the money, since I do not have the total money, when I borrow this money, I will be paying certain interest expense on this borrowing. Let's say at the end of year one, I am paying interest worth $50,000. So this $50,000 will be capitalized, even though interest is generally said to be a financing item which comes under the income statement, and it is supposed to be expensed. However, any borrowing which is directly related, which has been taken for the purpose of construction or acquiring any sort of fixed asset, such interest on any interest on such borrowing is supposed to be capitalized. Now there are certain conditions. Let us read about what conditions are supposed to be met for capitalizing the interest. Now note, it is the only interest that is supposed to be capitalized is those that is taken for construction of any building or machinery or any long lived asset. When any company constructs, not purchase, constructs, so there should be a long period, right? Even though acquire is written under the standards, you when we get to the standards and when we read about the conditions, we'll find out that construction is compulsory, because the longer period of time taken to for construction is very relevant. Whose preparation, or in this case construction, takes a long period of time. So when we have taken a borrowing for the construction of any building or any plant or machinery whose construction is taking a long period of time, the borrowing cost directly related to the construction are capitalized as a part of the cost of the asset. So now, for example, let's say in this example, I have said that the 500,000 was directly taken for the borrowing of this asset. Now, what if these 500,000 were general borrowing? Like, I have taken a borrowing, I have now mentioned why am I borrowing this money. In that case, am I still supposed to capitalize the interest expense? That will depend whether whether the proceeds of the borrowing have been utilized in the construction of the building. In case the proceeds from the borrowings have been directly utilized in the construction or acquiring process of the plant and machinery or building, then that interest figure is supposed to be capitalized. I hope everybody is able to we have completed these two paragraphs, and I hope everybody is able to understand what I'm trying to say. So for example, in this example, like I said, that I am going to incur $1 million and 500,000 is the total borrowing that I've taken directly. So cost of building to be recorded in balance sheet. Cost incurred directly is $1 million, right? And then apart from the costs that are directly related to the material and labor incurred on the building, we are also incurring interest expense on the borrowing which is directly related to the construction of the building, which will come to 10% of 50,000. So 1 million and 50,000, that will be the cost that is recorded in the balance sheet as property, plant and equipment for the purpose of this building. Now let's say the borrowing is still not paid. The building is ready for use and the borrowing has still not been repaid, and we are continuing to incur the interest expense. Will year after year the interest expense keep on accruing and adding to the property, plant and equipment value? No. That is why I said that there is a condition, and the capitalization of interest needs to be stopped when the asset is ready to use. See, the interest payments are capitalized and made prior to the completion of construction. And since this interest expense is being added to the value of property, plant and equipment under cash flow statement also, when we were learning about cash flow statement, we learned that interest expense. Everybody please think, where does interest expense come? So interest expense under IFRS is allowed as either operating or financing. But under US GAAP, it is mandatorily required to record interest expense as operating item, right? But in the specific case, when the interest is in relation to construction of a building, then for IFRS, it will come under investing. So the cash outflow on such interest will be recorded in a cash flow under cash flow from operating activities. Under IFRS, the expense interest may be classified as cash flow from operating or financing, classified as cash flow from investments. Again, this option is available under IFRS, but under US GAAP, it will continue to be operating. I hope these points are very clear to everybody. So interest needs to be capitalized given the interest is directly related to the construction of the property, plant and equipment, and it is to be capitalized till the construction is completed or the asset is ready to use. Now in case, let's say that I am a builder and buildings are a part of my inventory and not property, plant and equipment. Even under that case, the interest expense in relation to the construction of such an asset will be capitalized, and if it is inventory, then it will become a part of my closing inventory. And when that building is being sold, then that interest expense will become a part of my cost of goods sold. So what does this mean? Let me just give you an example so that nobody gets confused. So let's say I am a builder and I am constructing buildings for the purpose of selling them. I am constructing 10 buildings worth $1 million each. Right. Now I have taken a loan for $5 million. And I've paid an interest expense of, let's say, $500,000. Now at the end of the year, all my 10 buildings are ready for sale. But all the 10 buildings are ready for sale, but I have not sold any. So in my balance sheet, under the head inventory, I will be presenting 10 million and 500,000. So that comes to $10.5 million. So that is the value that will come under my balance sheet. So this interest expense has come under inventory. Now let's say in the coming year, I sold all 10 buildings for, let's say, $20 million. So sales or revenue figure will be $20 million. Cost of goods sold, COGS. We have already discussed a lot about COGS. So COGS is going to come around $10.5 million. So in this case, you see that the 500,000, which was an interest expense in the previous year, is coming under the COGS section. So that is what we are trying to explain when we say that the interest will be presented as a COGS. So it is included in COGS. Now the new interest, the again 500,000 interest will be paid in case we have not repaid the borrowing. Now the new interest will not be capitalized anywhere since all the buildings are ready for use. So the new interest will be coming under the head finance cost under the PL of the company. This comes to $9 million profit. I hope everybody is clear with these points. So when is the interest expense supposed to be capitalized? How much interest to be capitalized, and till when it is to be capitalized. If it is inventory, then also it has to be capitalized, and it will ultimately be expensed as a part of COGS. Now let's move to intangible assets. There are three ways when intangible assets how intangible assets can be acquired. Three ways. Number one, when we are going to buy any different company. As a company, I'm going to buy the business of another company, and let's say the physical assets of that company is worth $1 million, and instead of 1 million I paid $1.2 million to purchase that company. So the additional $200,000 that I paid is for the goodwill. So this is the recognition of an intangible assets due to acquisition. So that is acquired in business combination. That is one. Second, I can develop it internally. Like I said, that construction of a new machine which I can sell. So that is the development of new know-how. Patents. So sorry, patent will be coming under purchased, since patents have to be acquired. Developed internally is the research and development that I'm doing on new product which I'll be able to sell for a long period of time. So that is something that is being developed internally. That is developed internally. And finally, the third one is purchasing from outside. For example, let's say in today's world, data has become very important, and I'm going to buy customer lists from any other company. I'm going to buy the data of many customers from a data selling company. Those customer lists are available on my website, are available for me in an Excel sheet that they have sold to me. Now I have paid money to buy that. I cannot touch it. I cannot physically touch it, right? So it is a part of intangible assets. So now we'll learn about how do we record each type of intangible assets in our books of accounts. Starting with the easiest, intangible assets which are purchased in situations other than business combination, means normal purchase. For example, the example which I just gave you right now, I am going to purchase data from a data selling company. So intangible assets such as patents. So even patents, I said that patents are rights that the government gives to us for exclusivity on selling certain goods which I have manufactured, I have invented, or I have discovered. So that is a patent, right? Now to get the government to grant me a patent, I need to pay the government a certain sum of money. For example, let me say I paid $100,000 for a patent which will be active for 5 years. So for I paid $100,000 to the government, and that patent will be giving me benefits for 5 years. So it is giving me future economic benefits. It has an identifiable cost, and I cannot physically touch it. So what does all 3 points make it? It is a long-lived asset, and under long-lived assets, we can say that it is an intangible asset. Are recorded at their fair value. So the value that we are paying to the government will be automatically deemed to be the fair value, since we are buying it from an open market. Hence, such an item, the value that we are paying to obtain such intangible asset is considered to be its fair value, which is equivalent to its purchase price. If several intangible assets are acquired as a part of the group, each asset price is allocated based on its fair value. So what does this mean? Let's say I go buy 10 intangible assets for, let me say, $20 million. I paid $20 million to buy 10 intangible assets. I do not know what those 10 intangible assets are, but right now that is not relevant. What I'm concerned is I have paid $20 million to buy 10 intangible assets. Now, what if I tell you that had I gone to buy those 10 intangible assets individually, it would have cost me $30 million instead of $20 million. So how will I recognize the value of each asset in my books of accounts? So in this case, what will I do? I will divide this cost, the amount of money that I've paid to buy the 10 assets together. I will divide it in the ratio of their fair values. So let's say if asset A was worth $3 million individually, B was worth 5 million, C was worth 500,000. In that way, I hope everybody can understand. Rather, let's take an easier example so that we can calculate it for you. Let's say I buy 3 intangible assets, not 10. And individually, had I gone to buy them individually, then I would have had to pay for asset A $10 million, for asset B $15 million, and for asset C $5 million. So I would have had to pay $30 million had I bought those individually. So the fair value of the assets are 30 million in total. But how much did I pay? I paid $20 million in total. So in this case, what will I do? I will record asset A as $20 million multiplied by 10 by 30. Asset B at, and asset C at 20 minus these two is 3.33. I hope you all can understand this line. So in case intangible assets are acquired as a part of the group, each asset's purchase price is allocated based on their fair value. Next, this is the more important section of this intangible assets part. What if we develop intangible assets internally? So we are not going to buy it from any outside source, but we are developing our own intangible assets. For example, the most common thing will be a know-how. So I am, let's say, a pharmaceutical company, and as a pharmaceutical company, what is the biggest asset that I am going to have? The unique items, the unique drugs that I'm being able to produce. So in this case, when I say drugs, that means medicines. SKUs, the new SKUs. SKU means stock keeping units. The unique medicines that I'm going to develop over the course of running my business, that is the major main asset. And for that, I am, as a pharmaceutical company, I am going to spend millions and millions of dollars for research and development. Let me pull out the financial statements of any pharmaceutical company and we can see. So I have brought out the financial statements or the annual report of Pfizer. This is, I hope everybody knows the name of this company because they were the ones which started with the COVID. Excuse me. So they were the among the first companies to bring out a vaccine for COVID. So now let us see. So let's head to their financial statement section. So under their financial statements, let me just search for research and development. So research and development is a very major portion, is at the heart of fulfilling our purpose, right? So research and development is one of the most important things for any pharma company, and it will lead to the creation of intangible assets for any such sort of pharmaceutical company. So when I gave an example of pharma company, that does not mean that other companies won't have any in-house intangible assets, but pharma companies will always have, right? So that is why it is the best example. Yeah. So see, how much money have they spent on their research and development? This money is in millions of dollars. So they have spent almost $14,000 million. Almost $14,000 million on their research and expenses for the year 2021. See, it is a significant portion even for Pfizer. So a significant portion of the company is going to be expensed on research and development. So whenever any asset is being developed internally, we have to divide the process. So let's say the process is starting the R&D to selling the product. If this is the whole phase, then we need to divide into two halves. The first is the research phase and second is the development phase. So the entire process is being divided into research and development. So research is a separate portion and development is a separate portion. First we will understand the meaning of the two and then we will understand why this distinction and this divide is necessary. So under the research phase, it refers to that phase when the commercial feasibility of the product has not been established. So I'm producing a new product, but I do not know if I'll be able to produce any good which I'll actually be able to sell in the future. It is called the original and it is defined as original and planned investigation undertaken with the prospect of gaining new scientific or technical knowledge and understanding. Do not need to rote learn the definition, you just need to understand. So the intention is to develop a new product with the intention of gaining new scientific or technical know-how. The intention remains the same. However, the commercial feasibility of the output is not known. I am not sure whether my research and development process will be a success. So that is when every expense, every payment that I'm making during the research phase is supposed to be recorded in the income statement as expense. All payments made during the research phase should be expensed. But after we complete the research phase and the commercial viability of the product that I'm developing has been established, technical feasibility refers to the period during which the technical feasibility of completing an intangible asset has been established with the intent of using the asset for selling purposes. So two criteria must be met. Number one, the commercial feasibility must be established and I must have the intention to sell that product in the market to gain economic benefits. In case both the criteria is met, then we call it a development phase and every payment excuse me, I'm really sorry everybody. So every payment made during the development phase is supposed to be capitalized in the balance sheet of the company. I hope this is clear. So what am I saying? Whenever we have completed the research phase and entered into the development phase, then every payment is supposed to be capitalized as opposed to expensing every payment during the research phase. So IFRS and US GAAP both have minor differences. The difference is not anything major. So just let's read. So under what I told you right now was exactly about the IFRS phase. So expenditure on research to be expensed rather than capitalized, and development cost can be capitalized if technical feasibility and the intent to sell are established. So this is what is supposed to be done under IFRS. Under US GAAP, all expenses will be expensed. So nothing is supposed to be capitalized except for software. So in case of the United States, even if it is a pharmaceutical company or any other company, all expenses relating to research and development is to be expensed other than software related expenses. So if it is a software, then roughly it will be the same process as IFRS. So if it is a software, if you are developing a software, and it is meant for outside sale, then we will follow the same process as any other intangible asset in IFRS. That is, once the technical feasibility is established and the intent for sale is established, then we can capitalize all the expenses after it starts the development phase. So a software which is meant for sale. However, if it is a software meant for internal use that we are developing, then all development costs should be capitalized since the intent for sale will not exist. So let's just divide IFRS US GAAP. So under both IFRS and US GAAP, all research expenses are to be presented in the income statement. Now the difference is development expenses to be capitalized once technical feasibility and intent for sale is established. Under US GAAP, all development expenses also presented in income statement as expense. However, exception if software meant for sale, then we'll follow this method, and if software for internal use, then all development costs will be capitalized. I hope everybody has understood these points, the difference between the research phase and development phase, and which expenses are to be presented in the income statement and which expenses are to be capitalized and shown in the balance sheet of the company. Now finally, the third point that we mentioned, that certain intangible assets might be acquired as a part of the business acquisition process. So when, let's say, a very good example will be, so Facebook acquired WhatsApp. I don't remember, but I guess it was something around 16 to 20 billion dollars that Facebook paid to acquire WhatsApp. So let's say it's paid 16 billion dollars. So when Facebook is acquiring WhatsApp, what will Facebook find in the books of WhatsApp? Several tangible assets, several intangible assets, such as patents, such as computers, and certain other assets. So all these assets will be recorded at their fair value. So let's say tangible assets are $5 billion. Intangible assets which can be identified, let's say are $5 billion. The fair value of these assets are $5 billion. And other assets are, let's say, $3 billion. So Facebook but paid $16 billion for something that is worth $13 billion. So in this case, the difference of $3 billion, that is the goodwill or unidentified. So it cannot be identified. Under this method, the acquiring entity allocates purchase price to each asset acquired and each liability is assumed based on their fair value. So once all the assets and liabilities are recorded on the fair value, if the purchase price exceeds the sum of the amounts that can be allocated to individual identifiable assets and liabilities, the excess will be recorded as goodwill. I hope this point is very clear to everybody. If we are overpaying for certain things, then it will be recorded as goodwill. And why is Facebook paying $3 billion extra to purchase WhatsApp? Because of the name, because of the brand value that WhatsApp has generated. Under IFRS, the individual assets that can be acquired include identifiable intangible assets. So identifiable intangible assets includes the patents, trademarks, all that things. It does not include goodwill because goodwill is unidentifiable. If the that meets certain definitional and recognition criteria. Otherwise, if the item is acquired in business combination, cannot be recognized as a tangible or identifiable intangible asset, it will be recognized as goodwill. So anything which cannot be identified is recorded as goodwill. So now what is the effect of capitalizing and expensing? I believe that it is very, very self-explanatory and self-understanding for everybody. Because once we are expensing, if we are expensing the entire item in income statement, so what is happening immediately? Our profits are going down. The taxes that we are required to pay down during the year are going down. However, that is happening in the first year. And from the second year onwards, what will happen? In the second year, since there will be nothing to expense, the asset is still being utilized. So in the second year, the profits will be higher and taxes will be higher. So in the first year in which the payment takes place, in that year, the profits and taxes will be lower if we expense it. And from the subsequent years, the profits and taxes will be higher. On the other hand, if we capitalize in the first year, since we are expensing, we have not presented anything in the balance sheet, the value of assets will be lower. In case we are expensing, the value of assets will be lower. Now let's go to capitalizing. If we are capitalizing, the value of assets will be higher. And in the income statement, if we have capitalized, that means we are recording only a certain portion of expense that can be allocated, that is as depreciation. So in that case, the expense will be lower. Assets higher, expense lower, profit higher. Profit higher means tax higher. So let us understand all this using a chart. Let us understand each line item in this chart. So if we are capitalizing, the total assets will be higher because, let's say, by building $1 million. So under expensing, we are presenting that $1 million under expenses or under income statement. And under capitalizing, we are presenting that as an asset in balance sheet. So if we are presenting in balance sheet, then the value of assets will be higher. However, if we present in income statement, then the assets will be lower. If assets are higher, that means again shareholders' equity will be higher. Why is shareholders' equity getting reduced under expensing method? Because shareholders' equity includes the profit, it includes the retained earnings. Since if we expense it, then the profits will fall down and the value of shareholders' capital, shareholders' equity, which includes the profits going down, so shareholders' equity automatically going down. So assets higher, shareholders' equity higher. Income variability will be lower. What is income variability? So for example, if let's say in the first year we are expensing the entire amount, then what is happening? In the first year, the income is very low. but in the consequent years, in the subsequent years, the profits are very high. However, under capitalization method, when we are allocating the expense as per the utilization of the asset, then what is happening? The income is roughly the same over all the 5 years. So that means variability means the change. So under the first method of capitalizing, what will happen? The income, assuming it is a mature company and not growing very much, the profits will grow slightly. So the profits will be, there will be a straight line, or there will be not much variability. However, in case of expensing, the first year will show very high profits, then very low, sorry, the first year will show very low profits. Since we have expensed this, the first year will show very low profit, and then second year will show very high profit, and then it will be constant line. I hope this point is very clear to you. So there is this major variability in income that takes place under the expensing method. Since in the first year of purchasing the asset, there is a significant capital outflow, so it will result in much lower profits in the first year. Now in the first year, there will be very low profits in under expensing, and the profits under capitalizing will be higher, because only a certain portion of the value of the asset is being allocated to the income statement in the first year. However, in the subsequent years, under the expensing method, the profits will be higher. Since the entire value has already been expensed in the first year, there is nothing to expense in the subsequent years. So in the subsequent years, there is no expense of depreciation. Whereas under capitalization, since we are providing depreciation year after year, so the overall value, the overall income will be lower. Let's just take a quick example. Let's say year 1, year 2, year 3, year 4, year 5. Company earns her earnings before interest, taxes, depreciation and amortization of $1 million every year. Now under capitalization method, we are providing depreciation of, let's say, 100,000 every year. So every year it is 900,000, the profits. So the company is earning stable. The income is, the variability of income is zero. The company is able to maintain stable profit rates. But let's say if we were expensing it in the first year itself. So purchase of asset 500,000 in the first year and 0,000. So in the first year it will be 500,000, and in the following years, every year the profit will be presented as 1 million, 1 million, 1 million, 1 million. What is one thing to be noticed? Under capitalization, what was the total profit? 900,000 multiplied by 5 equals to 4.5 million. And under this method also, it is 4 million plus 500,000. So that is $4.5 million. So under both the methods, the total profit that is earned over the years will be the same. The only difference will be when the profit is recognized. So under expensing, a lower profit is recognized in the first year, and consequently in the subsequent years a higher profit is recognized. Whereas on the other hand, under capitalization method, similar profits are earned all through every year. Now cash flow from operations. Why is cash flow from operations higher under capitalizing? Since when we are presenting it as a capital asset and capitalizing it, the expenses that are incurred, the money that is paid to buy the asset, is presented as a cash outflow and presented under cash flow from investing activity. So under capitalizing, the value of the cash outflow is presented under cash flow from investing activity. So CFI is lower and CFO is higher. And similarly under expensing, CFO is lower and CFI is higher. Now debt ratio or debt to equity ratio, since we have not assumed any sort of debt that is being taken, what is the only difference? In the denominator. So what is the difference that is happening in the denominator? The value of equity the debt is remaining the same. However, under capitalizing method, the value of assets is higher. The value of assets and the shareholders' equity is higher. Since the denominator, the debt is remaining constant, so debt to equity is debt by equity. So the numerator is remaining constant under both capitalizing and expensing. However, under capitalizing, the denominator is increasing, and under expensing, the denominator is reducing. So if the denominator is higher, that means the ratio will be lower. So under capitalizing, the denominator is higher, that is why the ratio is lower, and under expensing, the vice versa, the denominator being lower, the ratio will be higher. What is interest coverage ratio? What is interest coverage ratio, everybody? Net income plus interest divided by interest. Now under this, the interest expense is remaining the same, so the denominator is the same. The only difference being depreciation. The only difference is depreciation. So what is the numerator? Net income plus interest expense divided by interest expense. That is the formula. So in the first year, the net income will be lower under expensing. So the denominator is lower under expensing in the first year. So that is why in the first year, the interest coverage ratio for expensing is lower. However, in the consequent years, it is the complete opposite. So under expensing, you can see that this is the net income. So the net income is lower in the first year and higher in the following years. Whereas under capitalizing, every year it was 900,000. So under capitalizing, it was higher in the first year but lower in the consecutive years. So higher net income. What does higher net income mean? Higher net income means higher interest coverage ratio. So capitalizing will give us a higher net income, higher interest coverage ratio in the first year and lower in the subsequent years. And vice versa for the expensing method, we'll have lower interest coverage ratio in the first year but higher interest coverage ratio in the following years. And the very same ideology can be applied for return on asset and return on equity, because both will give both are in both the ratios. Net income is on the numerator. Net income or return available to equity shareholders, which is again related to net income. So since net income is in the numerator, under capitalizing, the net income will be higher in the first year and lower in the subsequent years. And for expensing, the net income will be lower in the first year and higher in the subsequent years. Accordingly, we will have higher ROA, ROE in the first year for capitalizing and lower in the subsequent years. I hope this chart is very clear, because this is the only relevant portion from these two slides. This is nothing but this chart in word format. So once you understand this chart, you don't need to understand anything else about the effect of capitalizing or expensing on the various line items of the financial statements and various ratios. I hope the first part of this chapter is clear to everybody. Now we'll be taking a short 10 minutes break and we'll be continuing our class again by 6:40. Welcome back, everybody. So let us restart our class. So once now that we know what exactly is capitalized and what is expensed and what is the impact of capitalization as opposed to expensing any sort of payment that we are making in relation to long-lived assets, now let us get to allocation of the capitalization. So now we all know depreciation is nothing but the allocation of cost of tangible assets over its useful life, over the years which is during which the asset is helping the company to earn future economic to earn economic benefits. So depreciation is the process of allocating cost to tangible assets over its useful life. Useful life means the years in which it is helping the company to realize economic benefits based on the cost model. Now, whatever we'll be doing right now will be the cost model of reporting long-lived assets. The capitalized cost of long-lived tangible assets other than land. Why is it written other than land? First of all, because land has no life. After 10 years, do you expect the land to disappear? Or will the land go somewhere? The land is going to stay with the company for perpetuity till we sell it off. So the economic benefits from the land will not stop accruing to the company. That is why it is said other than, because there is no depreciation on land. Land is one of the assets on which depreciation will never be charged. So apart from land, the capitalized costs are allocated to the subsequent periods as depreciation expenses. In the alternative model, the revaluation model, a company reports long-lived assets at their fair value rather than acquisition cost less accumulated depreciation. We learn about the the revaluation method later on. Okay. So first of all, let us understand the various methods of depreciation. What are the methods that we can use for depreciation? Number one, straight line method. Number two, the accelerated method. And number three, the units of production method. These are the three methods that we'll be learning. There might be thousands of more methods. You can make your own method, but that is not relevant because that is not mentioned in the standards. So what we are only concerned about is what the standard tells us. So before moving on to the methods, let us understand a few terminology. What is historical cost? The cost that we pay to purchase the asset, or the entire value that is capitalized. Carrying value is the value, the written down value, carrying value, or it is also called written down value, or WDV. So it is historical cost minus accumulated depreciation. So year after year, the value of depreciation is adding up. So for example, if it is a $1 million asset and we are charging 100,000 depreciation every year. So after 1 year, the carrying value or the written down value will be 900,000. And after 2 years, it will be $800,000. So I hope everybody can understand what is the meaning of carrying value or written down value. And finally, economic depreciation is basically the actual decline in value of the asset. So if we are following the straight line value method, straight line depreciation method, and we are charging the same depreciation over each year, does that mean the actual value of the asset, if we go to sell it in the market, is also going to be the same? The actual benefit that will be accruing from the benefit from the machinery is also going to depreciate at the same value? That is not, obviously not the case. And the actual depreciation and the actual value of asset might decline faster or slower than the method which we are following. So the actual decline is called the economic depreciation on the asset. And now finally, one more term is which not mentioned here is residual value. This is the value which we expect to realize after we have completely utilized the asset, and that is the value we'll expect to utilize when we sell it off. For example, let us say it is a mobile phone. So we expect to use it for 2 years, and after 2 years, we expect to realize, let's say it is $1,000 phone, $1,000 iPhone, and after utilizing it for 2 years, I expect to sell it off again for $100. So this $100 is the value of asset, the value that will be receiving at the end of 2 years. This is called as the residual value. That is the value that will be realized at the time of after we have utilized it. So regardless of which method is being used, the carrying value can never go below the residual value. If the value of residual value has arrived, there will be no further depreciation on that particular asset. I hope this point is very clear to everybody. Now let us go on to the methods. Under the straight line method, as the name signifies, there will be the depreciation will remain the same every year. If we draw a chart of years and depreciation, the chart will be like this, because every year the same amount of depreciation is being charged on the asset evenly. So that the cost of the asset is distributed evenly over the life of the asset. Depreciation expense is calculated as depreciable cost minus residual value divided by the useful life of the asset. So like in the iPhone example, I said it is a $1,000 iPhone. The estimated residual value is $100 and I expect to utilize it for 2 years. So we will be charging 1000 minus 100 is 900, divided by 2 is $450. So we'll be charging $450 as depreciation over the 2 years of its life. Depreciable cost means historical cost minus estimated residual value. So depreciable cost divided by the asset's estimated value. So the depreciation under the straight line method will remain the same for each period. So in this case it was 2, it might be 10 years, it can be anything depending on which asset we are talking about. The depreciable cost is the historical cost of the tangible asset minus the estimated residual value, which we have already discussed. And we've also discussed the meaning of the residual value. So this is it. This is the simplest form of depreciation and there are no complications under the straight line method of depreciation. So I hope that we do not have to talk about it more. So now accelerated method of depreciation. Next, accelerated method of depreciation. Under accelerated method of depreciation, the cost is usually allocated higher in the first years and lower as we move forward. So there's a logic behind this method. The logic that they follow is that when we buy any new asset, it will run better, it will function better, so we will be gaining more benefits during the early years of the asset. For example, when we just buy the phone, it will be running very smoothly, and as we have used the phone for a longer period of time, the phone will become slower and we won't be able to make as much use of the phone as we might have been using it in the initial years of the phone. So that is the logic that the accelerated method follows, and that it means that more depreciation should be charged in the initial years because we are utilizing or gaining more economic benefits in the initial years of the machinery. So there are many accelerated methods. So accelerated method is a type of depreciation and there are many subtypes of accelerated method. We will be learning about two of those types. One is double declining method and one is written down value method, WDV method. The WDV method is not mentioned on your slide, but we will still talk about it. A commonly used accelerated method is the declining balancing method. This is the WDV method, declining balancing method. In this method, the amount of depreciation expense for a depreciation expense for a period is calculated as a percentage of the carrying amount. So let us take an example. Asset cost is $800,000. Installation charges $150,000. Transportation to factory $50,000, and let's say training to employees to use the machine equals to $100,000. So first tell me what is the what will be the cost to be capitalized. So in this case, the cost of the asset the installation charges, the transportation cost, these three will obviously be capitalized because these are directly related to the purchase of the machinery. Should we capitalize training? Training of the employees for using the machinery? No, the training, even though it might seem that it's related, it is not directly related to the machinery. It is not for the purchase of the machinery. It is a training cost which is different. So it will be expensed in the profit and loss or income statement. So the cost is 800,000 plus 150,000 plus 50,000 will total come to $1 million. Sorry. So the total cost of the machine is coming to $1 million. Now let us say that the residual value is $100,000 and useful life equals to 10 years. So let's first calculate the depreciation under the straight line method. So under the straight line method, depreciation equals to depreciable amount, that is the historical cost minus the residual value, that is $1 million minus 100,000 divided by the useful life of the asset, right? So this gives us $90,000 every year for 10 years. So that is the depreciation under the straight line method. So no matter which year we are talking about, every year it will be 90,000. For declining balancing method, let us consider one thing. So for declining balancing method, let us consider that the rate of depreciation is given 10%. So under declining balancing method, we will not be considering the residual value and we will simply apply the rate on the carrying value. So in the initial year, in the year we purchased, it was purchased for $1 million, right? So in year 1, the depreciation will be $1 million multiplied by 10% is $100,000. In year 2, what is the new carrying value? The new carrying value of the asset is the historical cost minus accumulated depreciation, that is 1 million minus 900,000. So 1 million minus 100,000. So $900,000 is the new carrying value. Historical cost minus accumulated depreciation. So the new carrying value of the asset is $900,000, right? So in year 2, the depreciation will be $900,000 multiplied by 10% is $90,000. Similarly, now in year 3, 900,000 minus 90 is $810,000. That is the new carrying value for year 3. So in year 3, the depreciation will be coming to $81,000. I hope everybody can understand. So in declining balancing method, the value of depreciation keeps on going down. However, one thing that we need to keep in mind is that even though we are not considering the residual value in the formula, if the value of the asset is falling below the residual value, then we will not charge any further depreciation on that particular asset. So the value of the formula for WDV method was X percentage, whatever the percentage that has been specified, multiplied by the carrying value at the beginning of the period. I hope this is very clear. And then there is one more accelerated method of depreciation in which the formula is 2 multiplied by book value at the beginning of the period divided by depreciable life in years. So it is combining both the written down value method and the straight line method. So for this particular example, let us consider the DDB method of depreciation. So in year 1, the depreciation will be $1 million. That is the carrying value divided by the useful life multiplied by 2. Where's the mouse? So 2 multiplied by book value at the beginning of the year divided by depreciable life in years. This brings to $200,000. So in year 1, the depreciation will be $200,000. In year 2, the numerator will change and there will be $800,000. So $1 million minus 200,000 is $800,000 divided by 10 multiplied by 2. That gives us $160,000. Similarly, we'll go on. In year 3, it will be 650 by 10 multiplied by 2, $128,000. So I hope everybody can understand the meaning of double declining method, double declining balancing method. So this is the DDB method, 2 multiplied by book value divided by depreciable life in years. So these are just examples of the accelerated method. You need to learn the formula of these two methods and they might be specifically asked in the exam. Again, we have just mentioned this, that's mentioned in the note. Even though the salvage value is not used in the equation of either of the methods, no further depreciation is accounted for after the asset reaches its salvage value. Now finally, unit of production method. So what is this? Let us say that I bought a new machinery. I'm a manufacturing company and I expect that the machinery will be able to produce 100,000 units over the course of its life. I expect the machinery to produce 100,000 units over the course of its life. Now let's say in first year, the machinery produced 15,000 units. In the first year, the machinery produced 15,000 units. So what will the formula we use? Original cost minus salvage value multiplied by units produced divided by life in number of units. So again, if we consider the same example, 1 million minus 100,000 multiplied by 15,000 units, which is the units we are assuming it is produced in during the year, divided by 100,000, which is the number of units, we expect the machinery to produce over its life. So this is giving us 900 multiplied by 15 divided by 100, 135,000. I hope this point is very clear. So again, in this the numerator is not the carrying value. In this the numerator is same as the straight line method. So in year 2, let us say the machinery produced 20,000 units. So the numerator will continue to remain as 1 million minus 100,000. And the denominator will continue to remain 100,000. The only thing that is changing is the number of units that were produced during the year. Right? So 900 multiplied by 25 divided by 100 gives us $225,000. I hope the unit of production method is very clear to everybody. So in unit of production, we will estimate the total production of the machinery over the course of its life, and we will allocate depreciation on the basis of the goods that is produced during that particular year. In the unit of production method, the allocation of cost corresponds to the actual use of an asset in the particular period. The amount of depreciation expense for a period is based on the proportion of the asset's production during the period compared with the total estimated productive capacity of the asset over its useful life. This is the same as we have already discussed. The depreciation expense is calculated as depreciable cost. Depreciable cost being this formula. So depreciable cost is original cost minus salvage value times the production in the period, that is output in units in the period, divided by life in output units, divided by the estimated productive capacity. The estimated productive capacity being nothing but the life and output units. It is also possible to estimate the depreciation cost per unit, that is the depreciable cost divided by the estimated productive capacity. So what is the depreciation cost per unit in the formula? So what we said is that this first section of the formula is remaining cost constant, and this constant portion is nothing but the depreciation cost per unit. So original cost was 1 million minus salvage value was 100,000, and if we divide this by total expected life of the asset is 100,000, so $900,000 divided by 100,000, so it gives us $9 per unit. So in this case, the depreciation expense per unit, the depreciation cost per unit is $9 per unit for our example. The depreciation expense can then be calculated by simply multiplying this value to the number of units that were produced during that particular year. I hope that this point is very clear to everybody. Okay, so again, now in the previous examples, we had learned what will be the impact of capitalizing versus expensing. Now we are going to understand the impact of straight line method versus DDB method. Sorry. So under what is happening under SLM method? Under SLM method, every year the value of depreciation is going to remain the same. So there's consistency year over year. Whereas under a DDB method, what is happening in the first year, the depreciation is very high, but it is gradually reducing. The total depreciation will always remain the same under both the methods, since depreciation is supposed to be stopped when the value of the asset reaches its residual value. So the total depreciation that will be charged over the years will always remain the same. Okay. So let us understand. Okay, under DDB method, what are we doing? It's depreciable cost divided by useful life multiplied by 2. Whereas under SLM method, what are we doing? Oh, so, I'm sorry. Under DDB, we are doing carrying cost. Sorry. Carrying cost divided by useful life multiplied by 2. Whereas under SLM method, what we are doing? We are doing depreciable cost, not carrying cost, divided by useful life. So in the first year, depreciable cost and carrying cost both will be the same. In the first year, this section of DDB and this section, the entire of straight line method will be the same. So in the first year, we obviously know that the DDB will exactly be the double of SLM method. So initially the depreciation expense under DDB is obviously going to be higher. However, towards the end of the years, when the value of asset is almost near its residual value, in that case, the value under DDB will be lower because the carrying value would have reduced significantly to reach closer to its residual value, whereas the numerator in the SLM method is going to remain the same over every year, because the depreciable cost is always going to remain the same. So I hope this point is very clear to everybody. Now, if we write WDV method also, if we add another method, can we write here? There is no place for me to write, but let me just write here. If we write WDV also, so in the first year, WDV, the main problem is, since the percentage can be anything, so it will depend on what percentage we are taking. That is why we could not draw accurate comparison. However, under WDV, if we say that the percentage, if we say that the depreciation in the first year is remaining the same, so let us say that the useful life is 10 years and the percentage is 10% for WDV method. In that case, in the first year, the WDV method will have a higher depreciation, but from consecutive year, in the following years, the later years, WDV will present lower depreciation. This is very clear from this example that we have already done. So in this example, under straight line method, the depreciation was 90,000 every year. Under SLM method, under WDV method, the first year depreciation under WDV was 100,000, then 90, then 81. So in the first year it was higher than SLM. In the second year it was the same as SLM, and then in the following years it was lower than SLM. So that was under WDV method. Whereas under DDB method, we find that in the first 3 years it is going to be higher than the SLM method. However, if we go even beyond that, if we go in the fourth year, 640 minus 128, so 512 is the new carrying value. 512 is the new carrying value divided by 10 multiplied by 2. It's coming to 102. So we'll have to go further down, but you can see that the value of depreciation is continuing to fall, and at some point it will fall below the SLM method. So even though the depreciation expense can be said to be higher in the initial years, in the final years it will be lower than SLM. The total depreciation cost over the entire life of the asset will be the same under every method. So it's written, compared to SLM, the rate of depreciation in DDB is double, making the depreciation expense higher in the initial years. So what is important here? In the initial years. Because we need to understand that ultimately the depreciation expense over the life of the asset is going to be the same. So if the depreciation expense under SLM is lower, then the net income automatically will be higher. Low expense means high income. That is self-explanatory. Similarly, high income means low income. High depreciation means low income. This is very self-explanatory. Now, since low depreciation has been charged under SLM, that means the asset value has not reduced as much. That means the property, plant and equipment value is higher. So the total asset value will be higher in SLM. And consequently, under DDB, since the depreciation charge has been higher, a higher value has been allocated to the income statement in the initial years, and the higher depreciation expense would lead to a lower value of total assets in the initial years. Corresponding to total assets, what is it? Corresponding to total assets, we get shareholders equity. Since the net income is higher under SLM, that automatically means a higher value is being added to the retained income. So equity is assets minus liabilities. Liabilities are remaining the same. Since assets are lower for DDB, then hence equity is also lower. Or alternatively, what we can say? Alternatively, we can say that since the net income is higher under SLM, that means a higher value is being added to the shareholders equity. That is why shareholders equity is higher. Now, return on assets is more complicated. Why? Because under SLM, both the income is higher and total assets is higher, right? Both the income is also higher and total assets is also higher. So can we directly say that the total that return on assets is higher? We cannot directly say, but what do we assume? We assume that the percentage impact on the numerator is greater than the percentage impact on the denominator. So what does that mean? That as a percentage of revenue, depreciation would be higher than the value of the asset as a proportion of the total asset. That is not very important for you to understand exactly, but I hope everybody can understand what I'm trying to say. The ultimately ratios depend on percentages. So if the percentage of numerator changing is greater than the percentage of denominator changing, then automatically the impact of the numerator would be higher. So in this case, since we are assuming that the percentage impact of the numerator is more than the percentage impact of the denominator, that is why we are saying that the return on assets will be higher under SLM method. Return on equity, again similar complications. So since under SLM method both the net income and shareholders equity is higher, we cannot directly say that the return on equity is higher under SLM, but again we are assuming that the percentage impact on numerator is higher. That is why the return on equity is going to be higher. Asset turnover is less complicated, since asset turnover, I hope everybody remembers the formula, is revenue divided by assets. So since we know that under SLM the total assets is higher, so that is why the asset turnover will be lower. What is better for a company? So asset turnover ratio is a activity ratio. And what do we assume? What do we want the activity ratio to be? We want the activity ratio to be higher or lower? We want the asset turnover ratio to be as high as possible. That means that we are able to generate more revenue per time asset that we have, per unit of asset, per value of asset that we have. So that is why we want as much asset turnover ratio as possible. So in the case of asset turnover ratio, SLM will present a lower asset turnover ratio, and whereas DDB will present a higher asset turnover ratio. And finally, operating profit margin, again it will be higher under SLM and lower under DDB. Now, just for clarification, all these is for the initial years. As when we move on to the later years, when under the DDB method the depreciation will be lower, in that case everything will reverse. Okay, so there's one concept called component method of depreciation. This was supposed to be done earlier, but this is just a very simple formula, simple explanation. So what is component? So let us say that I am going to purchase a very big asset. I am going to purchase, let's say I am Boeing, Boeing as in the plane manufacturing company. I cannot draw an airplane, but anyways, let us say that I'm going to purchase a plane. And while purchasing that plane, we can identify separate components. We can get the wings of the plane, we can get the body of the plane, we can get the engine of the plane, we can, so we can, I am I hope that I am very clear to everybody when I say that the entire plane can be separated into different components. So when any asset is so big that separate components can be identified, in that case, individual components or parts of an asset are depreciated separately. For example, that in the plane, it might be said that the wings have to be changed every 15 years, whereas the engine has to be changed every 5 years. So in that case, if we are following the SLM method for calculation of depreciation for the engine, we'll use 5 years, whereas for calculation of depreciation of the wings, we'll be using 15 years. Accordingly, we need to change the value of useful years for different components of the tangible assets. So I hope this point is very clear that we need to identify different components in case the asset can be divided into separate components, and we need to apply depreciation based on the values of those different components. So IFRS requires mandatory. So requires means mandatory. IFRS has made the component method of depreciation mandatory. However, under US GAAP, it is optional. And what, instead of doing component depreciation, we can charge depreciation on the total plane as a whole as well. I hope this point is also very clear to everybody. So component method of depreciation means dividing the asset into various components. So IFRS mandates the component method of depreciation, whereas under US GAAP it is optional. Now let us move to different amortization methods. So amortization, what is amortization? Amortization is the same as depreciation. It is the allocation of the cost of an intangible asset, whereas depreciation was allocation of cost of the tangible asset. So the only difference between tangible and intangible asset is the only difference between depreciation and amortization is that depreciation is for tangible assets, whereas amortization is for intangible assets. And both the terms mean exactly the same thing. Allocating the cost. Hmm. So Acquired patent or copyright with a specific expiration dates are in that we exactly know the life. For example, that we buy a patent and the government says that it will expire in 5 years. So in that case, we exactly know the useful life of the patent and we can depreciate it accordingly. However, if there's an acquired trademark, one second, where is the point? For example, let's say if there's a patent which can be renewed, indefinitely for a very minimal cost. Let's say we buy the original patent for $500,000 and we can renew the patent every year for a very minimal cost of, let's say, $100, and that is indefinite. We do not know till when the patent will be applicable. So in that case, can we actually provide any sort of depreciation? In that case, what we will instead do, we will not be charging any amortization or depreciation on that particular intangible asset, and instead what we will do, we will test the asset for impairment every year. We will get to the meaning of impairment at a later point of time in this particular chapter. And the different methods for calculating amortization are exactly the same as depreciation: straight line method, accelerated method, and unit of production method. I do not think that we need to go into details in this any longer. So these points are the same as tangible assets and they have just been repeated for intangible assets as well. Okay. So now let's get to, so till now whatever we did was based on the cost model. I hope that everybody remembers then when we started, we said that we are doing the cost model, but now we'll be starting with revaluation model. We'll be starting with revaluation model. Just let me show you once. Hmm. So till now, whatever the methods that we followed, that is the straight line method, accelerated method, or unit of production method, everything was under the cost model. However, now we will learn about the revaluation model. Under the revaluation model, what we do, under the revaluation model, assets are revalued periodically. We might state, say for example, the asset is bought in September, and we might say that we will revalue it every year. So every September we will find out the fair value of the asset, and we will value the asset at that particular value in our books of accounts. So the carrying value of the asset after revaluation becomes the fair value. This method is used when the fair value of an asset can be easily determined and is subject to judgment. I hope these points are very easily understandable to everybody. So under revaluation model, we will find out the fair value of the asset every period. It might be the end of the financial year, or we might find out the fair value at the date it was purchased every year. So even though the revaluation model seems very simple in terms of theory, it's very difficult to be followed in the practical life. That is why very few companies follow the revaluation model, because the judgment of the fair value of any product requires a lot of judgment. Now, IFRS permits the use of either cost model or the revaluation model for the purpose of valuation and reporting of long-lived assets, but revaluation is not allowed under the US GAAP. Okay, so what is the impact of the revaluation model? The impact of revaluation model on the financial statements depend on whether the revaluation initially increased or decreased the value. So in case the value of asset is increasing or decreasing, there will be different impacts, and there will be different accounting treatments for the revaluation of the fixed asset. Now let us get to what will happen. in case of revaluation model. In case of revaluation model, in case the first revaluation is a downward revaluation. So let's say the asset was worth $1 million, and on the first year of revaluation, it is, let's say, $900,000. So the first revaluation is downwards. The first revaluation is taking the value down. In that case, the decline will be recorded. The 100,000 decline will be recorded as a loss in the income statement. The 100,000 loss will be recorded in the income statement. And if there are any subsequent increase in values, let me give you an example. Year 1, year 0 is the year we purchased. We purchased for, let's say, $1 million. In year 2, the value goes down to $900,000. In year 3, the value is $1.2 million. In year 3, it goes back to $800,000. And in year 4, it goes to $500,000. So, in year 1, the decline of 100,000 will be recorded in the income statement. So let's do something like this. In the income statement, balance sheet, asset, and there's a thing called revaluation reserve. Year 1. At the end of year 1, the 100,000 decline is recorded in the income statement as an expense, and in the balance sheet, the 900,000 is the value of the asset that is recorded in our balance sheet. In year 2, the increase of the asset is by $300,000, but we will not be recording the entire 300,000 in this income statement. So in the income statement, we will only recognize till the extent of any previous downward revaluations. So in the previous years, the total downward revaluation was $100,000. So the maximum upward revaluation that can be recorded in the income statement is $100,000, and the excess revaluation up and above the downward revaluation will be recorded in the balance sheet as revaluation reserve. The asset will continue to be recorded at its fair value of 1.2 million. In year 3, when the asset falls to $800,000, so should we record $400,000 in the income statement? But we do have 200,000 as revaluation reserve. So first we will write down that $200,000, and we will only record $200,000 in our income statement as an expense, and in the balance sheet it will come as 800,000. And finally in year 4, the value of asset is declining by another $300,000, so it is falling to 500k, and there is no scope of revaluation reserve. So the revaluation reserve only comes into picture when the value of the asset rises above its historical cost. Every increment in the asset value above its historical cost will be recorded in the balance sheet as revaluation reserve, and anything that happens below its historical cost levels will happen in the income statement. I hope this point is very clear to everybody. So the initial decline is recorded as loss in the income statement. Later, the assets carrying amount increases. The increase is recognized as a gain on the income statement to the extent it reverses the revaluation decrease previously recognized. So in our example, to the extent of $100,000, to the expense of revaluation decline previously recorded. For the same asset again, any increase in excess of the reversal amount will not be recognized in the income statement, but will be recorded directly to the equity as revaluation reserve. So it will form a part of shareholders' equity. In case of upward revaluation, in case there's an upward initial revaluation, an increase in the carrying amount bypassing the, there will be no recording in the income statement. It is recorded directly under the revaluation surplus in case there's an initial increase in value of the asset. Any subsequent decline in the carrying amount first decreases the revaluation surplus, and any excess decline in value beyond the value of the revaluation surplus will be recorded under the income statement. Everything was covered under this example of mine. I hope everything is very clear till now. So now, before moving on to impairment, which is a very important portion of this chapter, we will take a 10-minute break and we will continue at 19:35 or 7:35 p.m. Welcome back, everybody. So let us get back to where we left off. Now we had completed the revaluation model, and now we will be starting off with impairment. So what is impairment? We learned that depreciation was allocating the cost of the asset over its useful life. Now what if there's a sudden decline in the value of asset? There is a sudden unexpected decline in the value of the asset. That is called nothing but impairment. So impairment reflects an unexpected decline in the fair value of an asset of an amount to an amount lower than its carrying amount. Whereas depreciation and amortization was to allocate the cost over the useful life of the asset. Impairment deals with unexpected declines in value. Now again, there are many differences under both IFRS and the US GAAP relating to depreciation, relating to impairment, and we are going to discuss the differences in IFRS and US GAAP. So under IFRS, it is mandatorily required for firms to annually assess. So firms are annually assessing whether any events or circumstances indicate an impairment loss has occurred. So the annual term is necessary here. So under IFRS, the firms are annually assessing whether there is any indication of any event or circumstances which indicate that the impairment has occurred. Whereas under US GAAP, an asset is tested for impairment only when events and circumstances indicate that the firm may not be able to recover the carrying value through its future use. So you might say that that is the same under both IFRS and US GAAP. They are basically saying the same thing, but there is a difference. So what is the difference? I want you to tell me by yourself. Please try and tell me by yourself. What is the difference between IFRS and US GAAP? Okay, so obviously the only difference being the term annual. So IFRS is testing for events every year, whereas under US GAAP we are doing the impairment testing only when events come to our consideration, which might take place even during in the middle of the year. So what we have mentioned under IFRS and US GAAP, we are considering the impairment only when there are events and circumstances which indicate that the value of the asset has fallen below its carrying. The carrying value exceeds the recoverable amount. So the recoverable amount is lower than the carrying amount. That is when we need to impair the asset. So an asset is impaired when its carrying value exceeds its recoverable amount. Again, this is also different in both IFRS and US GAAP. Under IFRS, we have mentioned that an asset is impaired when its carrying value exceeds its recoverable amount. However, under the US GAAP, an asset is said to be impaired if it fails the recoverability test. We will be discussing both of them in detail later. If impaired, the asset is written down to its recoverable value. If impaired, the asset is written down to its fair value. So under IFRS, it is written down to its recoverable value, whereas under US GAAP, it is written down to its fair value. So let us take examples. First, let us try IFRS. Year 0, we bought a machinery for $1 million. Year 1, we depreciated it by 10% to, let's say, $900,000. Year 2, it is $800,000. Now in year 2, there was an earthquake which majorly impacted the value of the machinery. So that is an event which tells us that the value of the machinery might have declined. So that event is an tells us that an impairment might have occurred. So then we'll make our assessment and we will find out the recoverable value. What is the recoverable value? What is the recoverable value? It is the higher of A and B. Please write this down. This is not mentioned in the PPT, but it is very necessary. So please write this down, everybody. It is the higher of these two. Fair value less selling cost or value in use. So this is the recoverable amount. Now again, what is fair value less cost? If we sell the machinery outright right now on today's date, if we sell the machinery that has impaired today, what is the fair value that we will receive minus any selling cost that we will need to incur to sell that particular machinery? That is the fair value less cost. And what is the value in use? It is the present value of all future cash flow if we continue to use the machinery as we are using. So let us say it was a manufacturing machine and it was helping us manufacture our inventory, our finished goods. So over the course of years, it will help us to manufacture goods in year 1, year 2, year 3, every year. So instead of selling it today, what will happen? What is the value of inventory that it will produce to us today? So we will discount present value of all future cash flows from use of the machine. I hope this is very clear to everybody. So in the case of value in use, we are saying that if we continue to use the machinery as we have been doing, or even if we, let's say, change the use of the machinery, then what is the value that we will derive from the continuous use of the machinery? And we will find out the present value. I hope everybody knows the meaning of present value by now. So we will find out the present value of all future cash flows that we will get from continuing the use of the machinery. That is the value in use. And fair value less selling cost is the amount that we will receive if we sell the machinery today itself. So let us say that the fair value less cost is $300,000 and the value in use is $400,000. So in this case, value in use is higher, so our recoverable amount will be $400,000. So the impairment loss will be $800,000 minus $400,000. So the impairment loss will be $400,000. I hope everybody can understand. Now let us say that that in the consecutive years, the recoverable amount increases. So now we expect that the value in use, instead of 400,000 in the next year, we expect that the value in use has increased to $600,000. The difference being $200,000, right? So even though we have written it out to $400,000, can we write it back? Can we write back the impairment in our income statement? Again, IFRS allows the write back to the extent of impairment recognized. So we have recognized an impairment of $400,000. So the write back will be allowed up to the value of impairment. If the value in use increases to say, let's say $1.2 million, in that does not mean that we will write up the value to again $1.2 million, because we are not following the revaluation model. We will continue to recognize the we will rewrite the impairment. We will reverse the impact of impairment to the extent of impairment realized. So if impairment, the value of asset is written down to its recoverable amount, subsequent loss recoveries are allowed, but they cannot exceed the historical cost. I hope this point is clear. Now under the US GAAP, an asset is tested for impairment only when events and circumstances indicate that the firm may not be able to recover the carrying value through future use. And under US GAAP, there is no concept of recoverable amount. There is no concept of recoverable amount. Instead, there is a recoverability test. So the recoverability test is failed if the carrying value is greater than the undiscounted future cash flows. Undiscounted being the key term. Again, same asset, year 0 1 million, year 1 900,000, year 2 800,000. Now events or circumstances took place which indicate impairment has taken place. First thing we'll consider is undiscounted future cash flows. So if we discount these future cash flows to its present value, what will we get? We'll get the value in use that we were using under IFRS, but under US GAAP, we will take the undiscounted future cash flows. If the undiscounted future cash flows are less than 800,000, let us assume they are $600,000. If the undiscounted future cash flows are, let's say, less than the carrying value of 800,000, then we will say that the asset is impaired and we will write it down to its fair value. We will not write it down to 600,000. We will write it down to its fair value. So now, in case of fair value, how is fair value calculated? Fair value is again the discounted value of all future cash flows. So which is again, let's say, $400,000. Excuse me. So what are we doing, everybody? We are first comparing the carrying value to its undiscounted future cash flows. Then we are writing it down to its to the value which is equal to discounted value of future cash flows. So for testing impairment, we are doing undiscounted, and then when writing it down, we are considering discounted values of future cash flows. Now let us do a sum. So company X purchased a machinery with original cost equals to $900,000, accumulated depreciation up to date equals to $100,000, expected future cash flows equals to $795,000, fair value equals to $790,000, value in use, let's say $785,000, and finally selling cost equals to $30,000. I want everybody to find out the impairment both under US GAAP and IFRS given events and circumstances have taken place which indicate that impairment has taken place in the particular asset. So let's start. First, we'll find out the carrying value of the asset. Carrying value is $900,000, that is the historical cost, minus the accumulated depreciation of $100,000, that is $800,000. Then, under IFRS, we'll find out the recoverable amount, which is the higher of fair value minus selling cost, which gives us how much? 790 minus 30,000 equals to 760,000, and higher value in use equals to 785,000. So RA equals to 785,000. RA is recoverable amount. That is $785,000. Right. So since the recoverable amount is less than the carrying value, hence we will write down the value of the asset to its RA. So carrying value minus RA, that is carrying value minus RA equals to 800,000 minus 785 equals to $15,000 of impairment will be recognized under IFRS. Now under US GAAP, we won't calculate any recoverable amount. Instead, we'll do the recoverability test, where we'll compare the carrying value to undiscounted future cash flows. So in this case, carrying value is 800,000, whereas future cash flows, undiscounted future cash flows are $795,000. Since the undiscounted future cash flows are less than the carrying value, hence we know that the impairment has taken place. Now we will write down. So the loss measurement, we will measure the loss, that is carrying value minus fair value. That is $800,000 minus $790,000 equals to $10,000. So under US GAAP, we are going to recognize an impairment of $10,000 as opposed to $15,000 of impairment recognized under the IFRS method. I hope everything is clear till now. So now we'll consider impairment losses for two specific types of items. One is long-lived assets held for sale and one is goodwill. Goodwill is not mentioned, but we'll still discuss about goodwill shortly. First, let us read about long-lived assets held for sale. A long-lived asset is reclassified as asset held for sale rather than held for use when it becomes obsolete and the management intends to sell it. For example, again, let us consider our mobile phone. We are using our iPhone 13. 2 years pass by, iPhone 15 comes around and iPhone 13 is no longer valid. Everybody wants to change and it has become obsolete in the technology market. So we want to simply sell it off. We are not going to utilize it and we are not going to gain any sort of economic benefits apart from the sale value that we are getting. So that is when we will reclassify the asset as held for sale. In this example, they have taken example of a building ceases to be used and the management intends to sell it, and the building is reclassified from PPE to non-current assets held for sale. So there's a specific classification under the accounting standards where assets which are held for sale should be reclassified from PPE to non-current assets held for sale. At the time of reclassification, when we are reclassifying the assets from PPE to non-current assets held for sale, assets previously held for use are tested for impairment. On that date, the date of reclassification is the date on which we will test it for impairment. If the carrying amount at the time of reclassification exceeds the fair value minus cost to disposal, in this case value in use will not be taken into account. If we are following IFRS, value in use will not be considered by us. Why? Because we are going to sell it right now. So what will we take? We will consider the fair value, that amount we expect to receive, less cost to dispose the asset, that is the cost to sell the asset. So the impairment loss is recognized if the fair value minus cost to disposal is less than the carrying value of the asset, and the asset is written down to its fair value minus cost to disposal. in that case, and the impairment loss is recognized. Another point is that a non-current asset held for sale stops to be depreciated, so there will be no more allocation of its cost over the in the income statement. Again, reversal also, in case of reversal, in case the value is later on determined to be higher, in case later we determine that we'll be able to sell the asset for a higher value, the loss can be reversed under both IFRS and US GAAP if the value of the asset recovers in the future. However, loss reversal is limited to the original impairment loss, like we have done in every previous options. I hope this point is very clear to everybody. Now, one more point we are going to discuss which is not mentioned here is goodwill. So goodwill is an unidentifiable asset, and there are two types of goodwill that we have discussed in previous lessons, that there is accounting goodwill and economic goodwill. While doing financial statement analysis, we are only concerned of the accounting goodwill because that is what is recorded in the books. Economic goodwill is not recorded in the books. So let us talk about accounting goodwill. Accounting goodwill arises only during business combination, or that is business acquisition, when we purchase, when we pay up and above the value of all tangible, fair value of all tangible and intangible assets. For example, in the WhatsApp example that we did in today's class, we said that that let's say Facebook paid $16 billion for assets worth $13 billion. So the additional $3 billion have been paid for the goodwill of Facebook, for WhatsApp. So now there is no useful life that can be put towards the towards goodwill. Goodwill is unidentifiable, and there cannot be any specific date or specific lifetime that can be placed on the goodwill of any asset. So in that case, we will not be able to charge any sort of amortization on goodwill. In that case, are we supposed to let goodwill stay at $3 billion throughout its life, whether or not the value of goodwill increases or decreases? Obviously not. We are supposed to record all declines, not increases, all declines as impairment. And goodwill is supposed to be tested for impairment every year, even in US GAAP. So goodwill is tested for impairment every year. Specifically, since goodwill is a special type of intangible asset, it is tested for impairment every year if the value of goodwill has declined and the impairment losses on goodwill are to be recorded in its income statement. I hope this is very clear to everybody. Now, let us come to derecognition. What do you mean by derecognition? When we remove the value of the asset from our books of accounts. So what are the cases under which we can remove the value of the asset from our books of accounts? Okay. So the ways in which assets can be derecognized from our books are: number one, if we sell it. So if we are going to sell off that asset, obviously we are going to remove the value of the asset from our books of accounts. Number two, abandon. In certain cases, we might find out that the cost of selling might be more than the value that we'll receive from selling it. So if we are going to get $100 and the cost of selling will be $200, will any rational person sell the asset, or they'll just abandon the asset? In case of abandoning the asset also, we are going to derecognize it from our books of accounts. Number three, exchanging the asset. For example, let us say we give our old phone to get a new phone. In that case also, we are derecognizing the old asset and we will be recognizing the new asset. And finally, we'll be reading about one more point, that is distribution to owners in a spin-off. We'll be understanding the meaning of spin-off also, and getting its meaning. Now, in case of a sale, of asset, what will happen? Let us say that the carrying value of the asset, that is historical cost minus accumulated depreciation, in our books of accounts is $100,000. And let's say that the asset is sold for $200,000. In that case, we will recognize the gain in the income statement. So a gain of 100,000 will be recorded in the income statement, whereas the value of the asset will be derecognized. In case there is a loss and the asset is sold instead for $50,000, in that case the $50,000 loss will be recognized in the income statement. So the difference between the sale proceeds and the carrying value is reported as gain or loss on the income statement. This is a very simple point and there is not much to explain. But let's move to abandoning of the asset. In case of abandoning, it is the same treatment as sale. It is assumed that we are selling the asset at 0 rupees or $0. So the carrying value, so the sales price, gain or loss, in case of sale is sale price minus carrying value. If it is positive, it's a gain, and it's a negative, it's a loss. So in case of abandonment, sale price is 0 and the carrying value, so the entire carrying value is the loss and it is recognized in the income statement. So the carrying value of this asset is removed from the balance sheet and a loss is recognized in the amount in the income statement. Assume sale at $0. So if you think it like that, it will be more easier to understand. Then let us consider exchange. In case of an exchange, we might also record gain or loss. So in that case, what will happen? We will consider the fair value of the new asset that is being received as the sale price. So for example, there is an exchange. I give my car to Mr. A and Mr. gives me his car. Mr. A liked my car more and I like Mr. A's car more. And as per the valuers, it is determined that Mr. A's car is worth $100,000 and my car was recorded in my books of accounts at, let's say, $80,000. So in that case, I will record the new asset, the new car in my books of accounts at, let's say, $100,000, and the additional $20,000, that is the difference between the sale price, that is the value of the car of Mr. A, and my carrying value of $80,000. So the difference of $20,000 will be recorded in my income statement as profit. Now, on the other hand, if Mr. A's car was valued at, the fair value of Mr. A's cars was $50,000 instead of, let's say, $100,000, then there will be a loss of $30,000 because my carrying amount was $80,000. So $80,000 minus $50,000, which is the new determined fair price of Mr. A's car, will be recorded in the income statement as a loss. So this is a treatment that we need to do in case of exchanging of an asset. I hope this point is also very clear to everybody. And finally, now let's understand what is spin-off. Let us say Meta. We learned that Meta has many companies that it has taken over. WhatsApp, Instagram, Facebook, Reality Labs. So let us say that Facebook determines that it will be better off if it runs Reality Labs as a separate company. So what they do is they spin it off. So what will they do? They will create a new company for the entire Reality Lab segment of their company, and the new company that is being formed, which will have the business of Reality Labs, will issue shares to the existing shareholders. So that is known as a spin-off. So in the case of a spin-off, the new companies will get all the assets of the old company, of one segment of the old company. So the assets belonging to the Reality Lab segment of the company is going to be spun off and it will be received by the new company, which will be issuing shares to Facebook or to the new shareholders of the company. This generally does not result in any gains or losses. We do not need to get into the details of spin-off. That's why I'm not going to the details. But if you want to know more about spin-offs, you can call me and we will discuss spin-offs in detail. There was a chart, I remember. Okay, I thought I had made a chart on impairment and revaluation, but no worries. We will discuss the effect of both impairment, revaluation, and then we will get onto the effect of derecognition. So when we are impairing the asset, what is happening? Immediately, what is happening? Immediately, the value of the asset is going down. So the total assets of the company is going down. Number two, what is happening? Number two, the value of impairment is recorded in the income statement as an expense. Hence, the profits are going down. So, what is the result of impairment? Assets down, expense up, profits down. Lower profits means taxes down. Since all these have been mentioned, I hope that you all can determine what will happen to the ratios automatically. Also, shareholders' equity down. So, impairment losses for PPE and intangible assets are recognized whether the assets carrying amount is more than the recoverable amount. When this occurs, the asset is written down to its recoverable amount. This is the definition of impairment which you have already learned. And loss is reported in the income statement. A new depreciation schedule based on the new carrying amount would need to be developed. So since the value of the asset has gone down, we need to recalculate the depreciation that we are going to charge every year. Right? Impairment losses result in a decline in the carrying amount of the asset from the balance sheet as well as the net income reported in the income statement. They do not impact the cash flows at all except for except for the impact on taxes. Next, revaluation. Revaluation of a company's long-lived asset changes the carrying amount to its fair value. The fair value is reflected on the company's balance sheet. If revaluation results in an increase in the carrying amount, the increase in assets will appear in the other comprehensive income. So what had we learned? If there was an initial increase in revaluation, then it will be recorded as revaluation reserve. It will not be recorded in the income statement, right? So there will be no impact in the net income. And in the initial increase in value of the asset, the fair value of the asset is recorded as revaluation reserve. So what will happen? The shareholders' equity is going up and the value of asset is going up. However, had there been a decline, then the decline will be recorded in the income statement and the value of assets will go down. This is what's written here. It's not very difficult to understand and it's not very relevant either. Because once you understand the meaning of revaluation and once you understand the meaning of impairment, you can answer all these questions by your own. So in case you are having any difficulties, please feel free to contact me at any time. If you have taken our classes, you will be provided with my mobile phone number so that you can contact me at any time. Okay, so I have just been told that somebody in the video has been asking for how to get the classes. So let me just show them once more. You can go to meplclasses.com, meplclasses.com. Once you log into meplclasses.com, you can go to the courses section and there you will go to the international courses segment. From international courses, you can select CFA from the categories tab and here you will get CFA course. You can see that you have the mobile phone option or the laptop option available for you. In case you are liking our videos and it is helping you study, please like, share and subscribe to our channel and press the bell icon. Every little thing that you do helps to motivate us to send more videos your way and to help you study better. Now, let's get back to long-lived assets. We were up to depreciation. We have completed the effect of revaluation and impairment. Now the effect of derecognition. As of due to derecognition, what will happen is that the value of the asset will be removed. The value of the asset is derecognized whenever it is disposed of and is expected to provide no future benefits emanating from either its use or disposal. Any gains or losses from its sale will be recognized in the income statement either as a component of other gains or and losses in the separate line item when the amount is material. These things are also that we have discussed in derecognition already. Now, Now we will get to the disclosure section. Now there are several disclosures that are required mandatorily under both IFRS and US GAAP. If we are following IFRS and US GAAP, either of the methods, then we will be required to disclose several items in relation to long-lived assets. Now what we need to understand is that disclosures under IFRS are much more complicated and much more detailed. So there's nothing to understand as such. If there's something to understand, I will be explaining it. But let us just read these slides to understand what are mandatorily required to be disclosed. These points, even if you have read twice, it is just important that you keep this in your mind, because these can be asked in your exam as one question. So even one question is important for us. Under IFRS, each class of PPE is required to be disclosed. We need to disclose the measurement basis, the depreciation method, the useful lives, the gross amount, the accumulated depreciation at the beginning and the end of the period, a reconciliation of the carrying amount at the beginning and the end of the period. So gross amount minus opening depreciation, opening carrying value, gross amount at beginning, at end, minus closing accumulated depreciation gives us closing carrying value. So all these things need to be disclosed along with the depreciation method, the useful life of all assets, the measurement basis followed. Everything needs to be disclosed under IFRS. The US GAAP requires less exhaustive disclosures. A company must disclose the depreciation expense, which has also been disclosed under IFRS, the balances of all major classes of depreciable assets, accumulated depreciation by major classes, and a general description of the depreciation methods used in computing depreciation expense with respect to major classes of depreciable assets. So what can be the just overview, the things you might not have understood. What are major classes? So for example, plant and machinery might become a major class, furniture and fixtures might become a major class, buildings might become a major class. So these are the major classes of assets, and we have mandatorily required to follow the same depreciation method for every major class of asset. However, two different major classes might follow different methods of depreciation. Now, what are disclosures relating to impairment losses? So under IFRS, a company must disclose for each class of assets for the following: the amount of impairment losses and reversal of impairment losses recognized in the period, and where those assets are recognized on the financial statements. For example, if there's an increase, has it been presented as a revaluation reserve or has it been presented in the income statement? If there had been an initial decline in value of the asset and impairment loss had been previously recorded, then it might happen a subsequent increase in value. The impairment might be written off, so that needs to be disclosed. The main classes of effects affected by the impairment losses and reversals of impairment losses, and the main events and circumstances leading to the recognition of those impairment losses. So we have learned that impairment will take place only when there are events and circumstances to tell us that there has been a decline in value of the asset below the carrying value, and that the recoverable amount will be lower than the carrying value of the asset. So we need to mention what events and circumstances were there in existence for us to determine whether or not the carrying value has fallen, should be lower. Under US GAAP, the impairment losses, the reversal for impairment losses for assets held for use is not permitted, so there's no point talking about that. However, the company must disclose the following: the description of the impaired asset and what led to the impairment, again the event and circumstances, the method for determining the fair value, the amount of impairment loss, and where the loss is recognized on the financial statements. So impairment is still very similar, but the disclosures for depreciation were much more comprehensive under IFRS than the US GAAP. Okay, before we get to analysis of disclosure and investment property, there's one more point that I need to mention. There are 2 points. One is changes in accounting policy and changes in accounting estimates. So changes in accounting policy, we have always talked about it, that it is retrospective. So if we change from straight line method to declining balancing method, that should be recorded as change in accounting policy, and it should have a retrospective impact. However, change in accounting estimate might be, let's say, change in the number of useful years of life. So for example, today I am estimating that the asset will be used for 10 years. 5 years later, I determine that the asset will only be useful for more 3 years. So total 8 years. So that is a change in accounting estimate. And the changes due to in depreciation figure due to the change in accounting estimate is supposed to take place prospectively, not retrospectively. So I hope that is clear to everybody. Now again, we learned so many things about the disclosures, but what are we? We are financial statement analysts. We are going to go read between the lines. We will understand what is the meaning of every disclosure and how is it useful for us. So the disclosures are giving us significant detail about the assets that are available in the financial statements, and we can use that to calculate these three ratios. What are these? The first one, average age. So accumulated depreciation is the depreciation that we are charging every year, year after year. So let us say that there are two machinery. Machinery A and machinery B. And machinery A, for machinery we charge $10,000 per year, and for machinery B we charge $20,000 per year. Machinery A's original cost is $100,000 and machinery B's original cost is $200,000. So after 2 years, assuming straight line method of depreciation, the total accumulated depreciation will be $60,000. So $60,000 divided by annual depreciation expense is $30,000. It gives us 2 years. So if we do not have this data and we are only given $60,000 and we are given the total accumulated depreciation and annual depreciation expense, which is something that is mentioned in the disclosures. We are not being provided the years when it was purchased and all that information. Then we can roughly figure out what is the average age of all the machinery in the books of accounts of the company. Now, why is that necessary? In case all the machinery are becoming old in the company, we will be able to understand that the company is becoming old, and probably it might not be able to operate its operations in the same efficient manner. A company which is continuing to grow year after year will keep on changing its machinery, and the average age will keep on declining. It will rise and fall. It will rise and fall. But if there's a constant increase in the average age of the machinery, plant and machinery of the company, then we will be able to understand that there will be a decline in the operational efficiency of the company. Total useful life, again given the same example, the historical cost was how much? $300,000 divided by, again, the annual depreciation expense was $30,000. Again, so this is giving us what? The total useful life. So we are getting the total useful life of the entire machine of the company. So we got the average age and the average useful life. From this 10 minus 2, what can we get? The remaining useful life. I hope this is very clear. So we are doing this minus this. So this formula minus this formula. What is it? Historical cost by annual depreciation expense minus accumulated depreciation by annual depreciation. Excuse me. So now what does this formula give us? Historical cost minus accumulated depreciation, which is nothing but the closing written down value. or the ending net PPE. PPE is property, plant and equipment. So closing WDV divided by annual depreciation, this will give us the remaining useful life. So these three ratios will help us to understand what is the life, what is the life of the entire fixed asset base of the company, what is the average age, or how long have we used those assets, and how long can what is the remaining useful life, or how long can these assets go on without replacing them. This is something that an analyst will look into. We will go beyond what is given to us and we will look in between the lines. And now finally, investment properties. This is something that we have already learned about. Investment property is those assets that are held for earning rental income or capital appreciation or both. So any fixed asset that is held for this purpose is known as an investment property. Under IFRS, companies are allowed to value investment property at either cost model or fair value model, which is similar to the revaluation model. The cost model is under investment property is identical to the cost model under PPE, but fair value model differs from the revaluation model used for PPE. There's a very minor change. Under the fair value model, all changes in fair value affect the net income. So both increase and decline both affect the net income. That is the only difference. Under US GAAP, investment property are measured using the cost model. So there is no revaluation model for US GAAP investment property. This ends our chapter for today. Okay, so let us take a 4-minute break, and at 8:25 what we will do is we will go through everything that we have done today. Get ready. After 4 minutes I'll be coming back and we'll be discussing everything that we have done today. Okay, so let us quickly go through everything that we have done in today's class and then we will end today's class. So, today we did LOS 23, which deals with long-lived assets. We learned about the different concepts of capitalized and expensed costs. What is capitalization? Capitalization means we are presenting the value of the asset in our balance sheet, whereas expensing the cost means writing it off in our income statement. Long-lived assets are those assets that are expected to provide future economic benefits. Future economic benefits is a necessary condition. These assets include tangible assets, intangible assets, and financial assets. The cost of long-lived assets are usually capitalized. Then we learned about capitalized assets and capitalized assets and expensing. I'm really sorry, everybody. So let us start again properly. There are three primary ways of intangible assets might be acquired. Number one is the purchasing in situations other than business combination. Number two, developed internally. And number three, acquired in business combination. Number one, intangible assets purchased in situations other than business combination. What we will do in this situation, in situations such as these, the amount that is paid for it and the fair that is considered to be the fair value, and we are recording them as a balance sheet item, or we are capitalizing the amount. Number two, we are intangible assets under development. This was the main thing that we read about. Under this, we will consider two periods. Number one is the research period and number two is the development period. In the research period is the time when commercial viability is not yet established. Development period is the time when commercial viability is established and we have an intention to use for sale, or we have an intention to sell the asset in the future to earn future economic benefits. For research phase, all the payments made during the research phase will be expensed in the income statement, and all the payments during the development phase will be considered and will be capitalized in our balance sheet. IFRS requires expenditure on research to be expensed, whereas development costs can be capitalized if technical feasibility and intent to sell is established. However, there's a difference in US GAAP because US GAAP does not require capitalization under development. Also, both research and development costs are supposed to be expensed in the income statement under US GAAP. However, the only difference being for for software. So in US GAAP, if there is a software that is being developed and the software is developed with the intent to sell, then the treatment will be same as any other intangible asset in IFRS, that is research expense to be expensed and development cost to be presented in balance sheet. However, if the software is meant for internal use, then even if the intent to sell is not there, then also all development costs are supposed to be capitalized. Then we want to intangible assets acquired during business combinations. All intangible assets acquired during business combinations, which can be separately identified and the fair value can be determined, are to be recorded at their fair value. However, if there is a payment beyond, up and above the value of the tangible and intangible assets fair value, then in that case the the amount that is being paid up and above the fair value of all tangible and intangible assets, in that case the up and above extra values will be considered to be goodwill, which is an unidentifiable intangible asset. Then we learned about the effect of financial statement on ratios. Total assets will be higher in capitalizing. Total assets and accordingly since total assets are higher, shareholders or equity is also higher. However, under capitalizing, since the income is being allocated every year, similar amounts of depreciation is being charged. Hence, income variability is lower. Net income in the first year will be higher in capitalizing, lower in subsequent years. Cash flow from operating will be higher in capitalizing since the entire payment is recorded in cash flow from investing. Debt ratio and debt to equity will be lower since the numerator is remaining the same, but the denominator is increasing. Interest coverage ratio will be higher in the first year and lower subsequently since the net income is lower in the first year and higher in the net income is higher in the first year and lower in the subsequent years for capitalizing. Similar as interest coverage and ratios, our return on asset and return on equity will also be higher in the first year, so lower in the subsequent years for capitalizing. All this discussion was for capitalizing of an asset. In case of expensing, everything will be reversed. Then we learned about the various depreciation methods. We learned about the straight line, accelerated, and unit of production method. The straight line method, we consider the depreciable cost, which is the historical cost minus the residual value, and we divide it by the estimated useful life and charge the same depreciation every year. Under accelerated method, we learned two methods, WDV method and double declining balancing method. Under the WDV method, an X percentage was multiplied by the carrying amount every year, whereas double declining method was 2 multiplied by the book value at the beginning of the period that divided by the depreciable life in years. Then we went to unit of production method, under which we consider that the asset will be able to produce a given number of units throughout its life. For example, let us say 1 million, it will be able to produce 100,000 units throughout the year, so we will depreciate in proportion to the number of units produced in that particular period. We learned about the effect of choice of depreciation on the various items. For example, depreciation expense under SLM will be lower than under DDB. Then net income will be higher under SLM. Total assets will be higher. Shareholders' equity will be higher. Return on assets and return on equity will also be higher. Asset turnover will be lower. However, finally, operating profit margin will be higher. So this is what we learned about the SLM method. Under DDB, it will be completely the reverse. Component depreciation, we learned that if there's a very large asset which can be divided into several components, then we will be charging depreciation on each component separately. We learned that amortization methods are the same as depreciation methods. Then we learned about the revaluation model, where we said that the value of asset will be recorded as its fair value. In case there's a rise in the fair value, in case there's an initial rise in the fair value, then what will happen? Then we will record the initial rise in the revaluation surplus, which is a part of shareholders equity. However, if there's an initial decline, then we'll record in the income statement. If there's a subsequent rise after an initial decline, then we will record the increase up to the value of previous decline in income statement, and any increase up and above the original historical cost will be recorded in revaluation surplus. Similarly, if we have already recorded a revaluation surplus, then any decline will first be adjusted with the revaluation surplus, and after revaluation surplus ceases to exist, then we will go on to the income statement. Then we learned about impairment under both IFRS and US GAAP. Under IFRS, we will check annually whether events or circumstances indicate impairment loss. Then we will find out the recoverable amount, which is the higher of fair value less cost to sell, or value in use being the present value of all future cash flows from the use of the asset. We'll find out the recoverable value, and if the recoverable value is lower than the carrying value, then we will we'll record a impairment loss equal to the carrying value minus recoverable value. Under US GAAP, there is no recoverable amount. Instead, there's a recoverability test, where the recoverability test is failed if the carrying value is greater than the assets undiscounted future cash flows. Undiscounted being the C keyword. If the impairment test, the recoverability test is failed, then the asset is written down to its fair value. While calculating fair value, this time we'll use the discounted cash flows. This time we won't be using the undiscounted but discounted cash flows. Subsequent loss recoveries are not allowed. So IFRS allows recoveries if the value of asset is recovered again in the future, but US GAAP does not allow such recoveries. We learned about long-lived assets held for sale, which are to be recorded at fair value minus cost to disposal. Value in use concept is not to be recognized here. Then we learned asset can be derecognized in case of its sale, abandoning, exchange of asset, or distribution to owners in a spin-off. These are the 4 conditions when assets can be derecognized. We learned the effect of impairment and revaluation. What will happen to the assets, liabilities, what will happen to the owner's equity and income. Then we learned about the effect of derecognition, which was similar and already discussed in the derecognition page. And then we discussed about the disclosures. The IFRS requires much more comprehensive disclosures than US GAAP. We learned disclosures about depreciation and also impairment. And finally, we went on to the analysis of disclosures, where we learned about 3 ratios, that is average age, total useful life, and remaining useful life. Average age being accumulated depreciation by annual depreciation expense, total useful life being historical cost divided by annual depreciation expense, and finally remaining useful life being the difference of the two. And finally, we learned about investment property and how investment property is the property that is used for earning rentals, capital appreciation, or both. And we learned that both cost model and fair value model is allowed under IFRS. However, US GAAP allows only the cost model. The fair value model is slightly different than the revaluation model, since there is no revaluation reserve and everything is recorded in the in the income statement. I hope you all loved today's class, and we have learned everything that is there to learn about long-lived asset. Tomorrow we will be learning all about income taxes and deferred taxes. Tomorrow is going to be a shorter class, so be prepared. I hope that we will end before 3 hours in tomorrow's class. So thank you everybody, and I'll take my leave now. Goodbye.